Good evening. Welcome. So when I drove up here, it was a balmy 4 degrees. Anyone can beat that temperature when they pulled up? Anyone see anything different in their car? 4 degrees, just 4. And you all decided to be here on this night, and so thank you for that. We greatly appreciate that. Before we get started, I want to acknowledge a few people that helped make the event possible. First, Millie Kitchen of JP Morgan Chase. Millie, she's the one that checks you in, and she always does a wonderful job. Ashley Juge, who helped with the setup and serving the wine, the most important thing, I guess, of the evening there, so thank you for that. Mr. Michael Collins back there, who's helping us with the video, and Margie Malott, who helped with the check-in as well. I also want to acknowledge our advisory board members. We have 10 wonderful people that help with the Opportunity Coalition. We have a few of the advisory board members here this evening. We have Sue Kenfield. Sue, with See It Thrive. We have Kyle Henderson with XL Companies. You already got to see Kyle. And we have Nicole Gamp. I don't know where Nicole, there she is over there. So I also want to thank the Innovation Pavilion. For those that don't know, we own this building. And we bought this building because of all the great opportunity that is created here. The Innovation Pavilion occupies the first floor of this building. It's a business incubator. Over 80 companies have been founded in the last couple of years here in this building. Youngest entrepreneur in middle school and the oldest individual is in his 80s. For those that have been here before, you probably get tired of hearing me say that. But those entrepreneurs are the ones that are creating jobs. Those entrepreneurs are the ones that are having a ripple effect throughout our community. And for that, we're grateful, and we're grateful that the Innovation Pavilion allows us to have the Opportunity Coalition here. I'm often asked, why did you found the Opportunity Coalition, and what is this organization? Well, this organization is to promote free enterprise. And I want to underline the word free. Free is important. I think it's one of the principles of our country. It's also to support entrepreneurship. And it's to bring speakers into this room who have golden nuggets of wisdom, who have been in different spheres of influence, who can share their ideas and their stories so that you can figure out how can it impact you personally in your business or in your life to go out and to make a positive impact. I really believe that we can learn a lot from other people. In addition to these speakers, I also host a weekly podcast on iTunes. It's free. And you can go to Opportunity Coalition on iTunes, or you can go onto our website. And in 30 minutes or less on your way to work, or with this weather, it may take you a little bit longer, you can hear some wonderful interviews with all kinds of people. And you can learn some wonderful lessons from them. And so I really encourage you to do it, and it is absolutely free. So that's a good thing. So tonight, before I introduce our guests, I want to talk a little bit about the banking industry. Has everyone here had a banking relationship maybe in their lifetime? Maybe I'll ask this differently. Has anyone not had a banking relationship? If you are, you might be in a certain industry that we just had a conversation about. We won't go into that. We are in Colorado, after all. But we're all touched by the banking industry, whether you want to be or not. Who remembers a few years ago when we had the greatest recession since the Great Depression? Do you remember where you were? Do you remember what it was like? I do. You see, we buy vacant commercial real estate buildings. And there were a few after the crash, but we also bought several before the crash. And I remember all types of banks and financial institutions crashing around us. I remember articles that said, should we still be following this system of capitalism in America? Does that make sense? I remember our federal government stepping in to take control of companies that were too big to fail. Think about that for a second. Talk about a fundamental shift in American society for the federal government to believe that its role was to come in and save certain companies, to pick winners and losers at the end of the day. And regardless of this political aisle, which side of the political aisle you may stand on, that is a fundamental shift in American society and has forever changed our country. I remember trying to go get a loan, and it was like crickets, trying to see what was happening. And a lot of these financial institutions, one, they were just trying to recover and see what was going on, and they were shuffling a lot of paper. And you think about the lifeline that banks have in our country. You see, they provide this thing called capital. And capital is the fuel of our business world. And frankly, our society in general. And once that capital stops, well, it affects a lot of things. Think to yourself for a second, how many friends declared bankruptcy? How many friends lost their home? We owned a property down in Florida at the time, and I remember the stat in the state of Florida. Over 25% of the homes went into foreclosure. You'd be hard-pressed not to know somebody who didn't lose a lot. And at North Star, we went right into the gauntlet. We owned a lot of vacant properties. And the vast majority of our lenders worked with us because they believed in this thing called character. And we were partners with them, whether they wanted to be partners or not. And they knew that even though we couldn't pay them all they wanted right then because the regulators were breathing down their neck, that we would go through that gauntlet. We would take our nicks. We may lose a limb or two, but we would make it through that gauntlet. Unfortunately, we had to deal with some lenders who either didn't want to or have the luxury of working with us. And so me personally, I personally guarantee the loans on these vacant buildings that I bring my investors into. And so I had to go deal with things like judgments, personal judgments. And it was a painful, painful time. But you know what? I wouldn't give it up for anything. A lot of people say, what are you, crazy? You have a judgment on your record, or you had to write these checks to these lenders. I wouldn't trade it for anything. Because in times like that, you realize your own mettle. You earn a few MBAs, and you have to pay for them, but I earned some MBAs in the banking industry. But you also realize who are the people that you want to work with. You see, there's some lenders in town here that they know that we would do anything with them and for them, and likewise them for us, within legal means, of course. And then there's other people that you realize, you know what, when your bullets start flying and you have some tough times out there, that they may not be the people that you want to work with. And so think back in your own lessons that you learned in that time. We all went through it. The question is, did you learn anything to apply in how you conduct yourself moving forward? And I would submit to you as well, embrace those challenges. Embrace those tough times, because they make you better at the end of the day. And I know they've done that for us. So with that, I'd like to have our guests come up. I'm going to introduce one of them, my friend, Don Childears. For those that don't know Don, he has served as president and CEO of the Colorado's Bankers Association since 1980. What were you doing in 1980? Long time. And he has lobbied for banking since 1975. And the reason why we invited these gentlemen here this evening is because they have a frontline knowledge of what's going on in the banking industry. Knowledge that will affect each of you, each of your companies, and each of your families in some way. And so with that, I welcome our guest speakers. Thank you.
Thanks, Brian. With your introduction, it reminds me how I started so long ago in this business when I inaccurately perceived banking as a very staid old business with no change happening in it. And since the mid-'70s, it's been kind of constant change. I mean, we've moved from a check-based business to ATMs, telephone banking, internet banking, now mobile banking, and banking actually is one of the leaders of innovation, or innovators of technology. And so it keeps things quite interesting. We'll get to many of the subjects that you referenced, but he gave an introduction of me, so I now want to give these guys an opportunity to introduce themselves. Both of these individuals have been chairman of our association in the last few years. And so, Dave, why don't I let you go first and just tell them a little bit about you and your bank.
Sure. Thanks, Don. My name is Dave Baker. I'm the president and chief operating officer for First Bank. I've been there 32 years. That's kind of our motto. We start entry-level management and then promote from within. Just a little bit about our bank. The lion's share of our business is in Colorado. We're the second largest bank in Colorado by deposit size. That's the only way you can really measure it or get the data of the competitors. We're about $12.5 billion in deposits, about $14 billion in assets. Our other two states, we have about 100 locations in Colorado. We've got 15 in Phoenix, Greater Metro Phoenix, and then 5 in the Coachella Valley, which is Southern California, like Palm Springs, Palm Desert area. So that's kind of our footprint. From a lending standpoint, we're mostly a real estate lender. Both residential and commercial real estate would be the lion's share of the lending that we do. So we've been around for 51 years. We're headquartered in out west on West Colfax and Lakewood. So I'll turn it over to Koger.
Hi, I'm Koger Propst. I'm with A&B Bank. A&B Bank's a privately held bank, headquartered here in Denver and Cherry Creek. We're about $2.3 billion asset bank. So out of the, say, 6,900 banks in the country, we're in the top 300. We're obviously tiny compared to the great big ones, but we're also of a size where we can do interesting things from a lending limit and technology, but still act as a community bank. We are in 33 locations, and primarily in Colorado, Wyoming, and then a small presence in Kansas City. Primarily a commercial bank with some consumer, well, obviously all the consumer products because we operate in a lot of small communities, but awful lot of commercial lending and dealing with small businesses.
Thanks. Brian referenced the meltdown and the recession a few minutes ago, and Koger reminded me about 10 minutes ago about a meeting we did in, I think, the summer of '09 out in this part of town, and it was with the Home Builders Association because their members were up in arms that they couldn't get loans. And it was probably one of the most hostile groups I've walked into. But Koger and another banker went with me, and we spent about 2 hours there walking through explanations of why we couldn't lend and why banks did other things. And by the end of that, I think we had a fairly educated audience. They didn't necessarily like what we had to say, but they understood the other side of the transaction. And so it's nice to be in a friendlier audience. Let me take a minute and tell you a little bit about the banking industry in Colorado. We have about 150 banks operating in the state. That's 100 of them domiciled here, 50 from out of state that operate here. And those 50 include not only the big banks that you know the names of quite well, but a lot of little community banks from throughout the Midwest that will have a couple of branches here in the Colorado Front Range area primarily. Those banks collectively have about $110 billion in assets, and we're only measuring the assets in Colorado on that basis. And we have gone through a lot of change. 20 years ago, we had about 475 banks, and so we've gone down to the 150 number, only 100 of them based here in Colorado. And we've become quite concentrated, and that's going to continue. Our 4 largest banks, 3 out-of-state banks and First Banks, constitute 55% of the market in terms of assets by themselves. So the other 145 banks have the other 45% of the assets. And when you get down into the lower part of the scale, under 100 million, which in banking terms is a very small bank, we have about 45% of all the banks in the state are at that size or below. And collectively, they only hold about 3.5% of the assets. So they are very small, and that is one of the reasons that consolidation is forced on them. That's a market force that says you need to be bigger to handle the administrative costs and spread that out over a bigger asset base. But the bigger issue that we deal with is the amount of regulation that is imposed on the industry. And we all got into the business knowing that banking was the most heavily regulated industry around, but there's a display in our office at the association that pretty well tells the story. We've put in a glass case the original FDIC Act, that is about, or Fed Act, which is about 30 pages, then the, Glass-Steagall, then the original FDIC Act, and we go the way through, and it works up to Sarbanes-Oxley, which gets up to like 80 pages. And then you have Dodd-Frank at 2,400 pages, like this. And at the 6.5-foot mark on the wall, we marked where we thought the 20,000 pages of regulations would end up, but we misjudged. We're above the ceiling at the current rate, and the regulations out of Dodd-Frank are only half done, basically. And so that will tell you about the enormous cost imposed on the industry, which obviously gets passed on to customers. And smaller banks just cannot stand that kind of load. So there's a little profile about the banking industry here in our state. But why don't we start off talking about the economy? And Koger, why don't we go to you first and just tell us how you see the Colorado economy progressing in the next few years.
Well, we're not economists, we're bankers, and so we look at it basically from our standpoint of how do we measure risk and how does it affect our customers. What I would say is that we have seen a dramatic turnaround here in Colorado. Don talked, earlier it was talked about when the Great Recession hit, and I would tell you that we would have customers that had capacity, that whatever they were working on may have made a lot of sense, and there was absolute fear and would not do those things. And what we're seeing now is that our customers are seeing a really active market. Certainly it's not across all industries, but it's in an awful lot of them. And our bank is doing an awful lot of for companies reinvesting in capital equipment, people, expansion, and so we see that as a really good sign. We are bankers, so we worry. We're pessimists. We're wondering what's going to go wrong and when. And so there's certainly headwinds. And when you look at the regulatory environment, on our industry, but also on our customers and what impacts that may have, the debt, when interest rates will rise, what kind of impact that will have. There's plenty of things to worry about. But particularly here in Colorado, we're pretty positive.
Dave, what would you add?
Well, I think Koger summarized it pretty well, so I'll try not to just repeat what he said. But these are pretty good times right now. I mean, when you see the restaurants on their signs, they say that they're hiring, not they're special on foods. I mean, the labor market has gotten tighter. You see the cranes in the air for construction, for example. If you want to build something today, you can't find a contractor for any size project. They are all, basically filled up right now. From a banking perspective, credit losses are very, very low. But this is also when you need to be a little bit more careful, because bad loans are made in good times. You just don't know it at the time. Everyone is chasing the A credit. All banks are chasing the A credits. Those are very ferocious. Pricing is very low on those. Interest rate environment is very low as well. But this is a time that you have to be a little bit careful, because everyone's doing stuff and they think it's going to be good forever, and we know that it won't be good forever. So you just have to keep that in mind. But generally, the economy is pretty dang good right now.
So you've heard that basically the banking business is about minimizing risk, and that means that we really pour over the credit applications that the customers bring in so that we can make those loans that are the least risky to the bank, because we don't want to be writing off that loan in a few years. Let's start with Dave this time, and would you just talk about any advice you would give customers in this kind of a market? I don't know about that one, Don. Advice that we would give. The economy goes in cycles. So we can't forget that there will be another down cycle and up cycles. It's never been the same for a long time. So I think people just need to
keep that in mind. I did want to comment a little on, one thing that Koger mentioned is sort of the amazing amount of regulation, not just on the bank, but on business out there. I mean, the Affordable Care Act, we're seeing that hit our business right now that it's fully implemented. Costs are going up. I mean, so that is going on throughout. So I don't know that I have any great words of wisdom for, the way to approach things today, but just other than to remember that they do go in cycles.
Okay. Koger, anything you'd pass on?
Well, I would add, Don mentioned the meeting with the home builders a few years ago, and at that time, banks in Colorado were the most active lenders of any in the country in construction. I'm going to rephrase that. Most active based on percent of loans in construction, commercial real estate, and land of any banks in the country. And I don't know if you all recall, but at that point, no money down, whether it was in mortgages, construction, things like that, became sort of the norm. And frankly, as an industry, and I would say First Bank was not one of those that went there on this irrational exuberance. But we all know the leverage is a good thing, but it's also gasoline, and it's extremely dangerous. And we got caught, and a lot of folks got caught, kind of going where you could, even though maybe it didn't make the most sense to do that. And we're seeing it again. It's amazing how fast we all forget, but there is a relaxing and things. And so just because a bank will do it doesn't mean it's good for your business. And finding banks that sort of are there for a long period and don't go to the riskiest point, I think, is really an important thing as a partner for your business.
Is there any advice you would give the really small businesses, the startups, if they don't get credit the first time they apply for it? What should they do at that point?
Well, this is a plant. You go to the Colorado Bankers Association website and look and click on a link, which is and now I'm not doing my job well. Tell me the name.
Smallbizlending.org.
Smallbizlending.org, and there's an awful lot. Actually, it is a great website. It was an initiative by the CBA to help address some of those. And what it does is brings together a lot of resources for non-traditional lenders, and there are a good number out there, so you can go and try and find those.
Add one thing that, very small business lending is not very efficient for banks, if you will, for the amount of information that we get versus the amount of credit. But I'm amazed to see some of the small business lending activity that's going on now outside of the industry. There are a lot of companies lending to small businesses where they're using automated scoring models, and they're lending at very high rates. And they're putting money out there today. It's almost a substitute for, I would say, how people started businesses with their credit cards, so to speak, sort of higher rate credit. But it's all they could get to get going, or borrowing from friends and family. But there's a pretty robust thing going out there with a lot of money behind it, where they'll make business loans to very small businesses, and they pay them back. The payment is due every day. It's not due once a month. It's kind of an interesting model. It has not been stress tested, by the way, but there's a lot going on there that that as traditional bankers, we're not really in the loop, or doesn't really fit in our model. And I think you're going to see more and more of sort of that online lending for small businesses. A lot of companies in that space right now.
And I think you'll see that happening on the other side of the bank, on the deposit side. We have a lot of unregulated non-bank entities moving into the payment system, most of them figuring out a way to skirt the law. But what you end up with when people think they've got essentially a deposit is money that they have turned over to somebody else that is uninsured. And so when one of those entities goes belly up, there are going to be a lot of people out of an awful lot of money. Since Dave is coughing, we'll go to Koger this time. What would you talk about technology on the deposit side of the bank? Where's that headed? What will people be doing in businesses or in their consumer life to interact with the bank going forward?
Well, as you guys all know, this is rapidly evolving, and what we're seeing as an industry is that it's about more distribution channels, more ways to connect, and certainly you're seeing it with more things that can be done through the internet, more things that can be done through mobile, both for the businesses and personal. We have a firm that is in our office building that is working on a person-to-person being able to sell used cars. All the way from, so if you want to sell it, you take a picture of your car, license, it drugs every bit of data in and helps you to find a buyer, finance it, register it, and so that sort of innovation is occurring all the way through every bit of our lives right now.
Dave, why don't you address that, what you see in terms of technology on the deposit side, and then the banking aspect of that, how big the branches are these days, how many branches you need compared to older styles of banking?
Yeah, so I'd say one thing on kind of the technology front, the payment system, is I think the most recent thing you may have seen is Apple Pay. And that's kind of an interesting one in that a lot of companies want to get in on the payment system, which has pretty much been the domain of banks. So I think you're going to see more and more things, on that front. And basically what Apple is saying is like, we have a lot of market power. We have these devices. There's a little bit of tailwind for them because there's been these data breaches, Target and Home Depot being the most recent. And they can say, hey, you won't get compromised with this technology because we're not giving that information to the merchant for them to compromise it. So I think there's something to that. And what Apple is saying is we want a tiny piece of the income stream, because there's an income stream to the payment system. We want a tiny piece of a lot of transactions. So that's really kind of their strategy, and I think you'll see continued innovation in that area. And we as banks are on one hand worried, on the other hand, some of that we can play in, as well. So, and switching gears a little bit to what Don has talked about, in terms of the industry, we really see that we need to have both a branch delivery system coupled with great technology and internet and the mobile being the latest kind of iteration of that. You don't need as many branches as you used to. So, for example, our company in Colorado has closed over 25 branches in the last 3 years. We will open and close branches every single year. I see that's the way of doing business going forward. There used to be a big stigma around closing a branch if you were a bank. That's kind of gone now. People kind of understand that, but we don't see it going to, I'd say, the extreme of maybe some other industries that have just basically disappeared off the retail map. I still see banks as being a combination, but you have to prune your branch network in order to remain efficient enough to really be financially successful. So I think that's what you're going to see kind of going forward, is that banks will prune their network. Koger's bank, I think they do the same thing, on that front as well.
I wanted to touch on the data breach issue a moment, because the generalization about that business is that you've had almost no data breaches by banks, and I know I run the risk of saying that and one happening tomorrow, but the big data breaches have basically been by retail companies, but the entities that pay for the expenses that come out of that are represented by these two guys here. The banks are the ones that have the inordinate cost of reissuing cards to all the customers so that they have replaced that card number that is out there in circulation. They're the ones who take the actual fraud losses when the customer, the credit card holder, is limited to certain losses or maybe no losses by use of their card. And so it's the banks that are taking those hits, not Target or Home Depot or anyone. So that's one of our many legislative objectives in Congress. I was talking with someone earlier, and they were asking about Community Reinvestment Act, and I said, yes, we still have concerns about that, but that's about 500th on our list of things. There are so many issues that the banking industry is focused on. But why don't we turn to one area where there's a lot of haze right now. And you'll forgive my pun, I'm moving into the marijuana topic, which you can't avoid in banking these days. And so I'll let Dave talk about maybe the lending side, and you talk about the deposit side. Does that work, Koger?
You can have it all.
One of you go.
Well, I don't think the sides, whether it's lending or deposit, are really much different. Basically, federal law prohibits banks dealing with companies that, deal in controlled substances. And so there's the state law conflicts with the federal law. Generally, all the big banks are not doing business with marijuana business, whether it's the lending or the deposit side. As the banking industry, we would rather see that change. It's good for society if that industry is banked from a number of standpoints. Security, tax collection, you can just kind of go down the line. That would be better for everybody. Until more states are in our boat, I doubt it will be changed on a federal level because you can't get the broad support in Congress. It's been tried. Our representatives have tried it. That's probably not going to change for a little while. There's a few banks that are playing with it because there's some mixed signals out there, and a few banks have gotten into business, but I don't think you're going to see any of the big ones really do anything in that business until the federal law is changed.
Okay.
Kind of short and sweet.
All right. Both these guys are pretty active on the political scene and understand our industry political issues. So, Koger, why don't you talk a little bit about how you see the future of banking after the election last week, how things have changed?
I will add one thing on the marijuana. One of the really sad thing about what it does is because people are desperate. And so as banks, we are under siege with people trying to open accounts, and they're doing it, and it turns them into liars and cheats and everything else because they got to figure out a way to come in so we can't catch them. And I'm sure Dave's bank's the same way, but we are finding people 2 to 3 a week where they've come in and we can't bank them and we got to kick them out, but they're doing things that are desperate. This law needs to be, it needs to be addressed if it's going to be, for all the reasons Dave said and the stress that it puts on them. As far as
Election.
how the elections will impact. So one of the things that we have an attorney on our board, recently joined. She's been really active in healthcare, which is obviously really highly regulated. And one of the things, she's been on for about about a year. And when she comes back and talks about the regulation and the burden that is on banking, it just blows her mind. And she says that she hasn't seen that in any other industry. And healthcare would be a good place you'd look. What's the impact of that? The impact of all that regulation ultimately is a lot of issues where we're effectively taking dollars or capital that could be deployed and put back into community, and we're putting it into an awful lot of things. And we have seen it in a number of regulations that impact people, it impact customers. And if you look at the single family mortgage market, frankly, if you look at as the new capital rules come on, all of those things mean less dollars available to people that are trying to do things, whether it's buy a house or start a business. So what's the election mean? I personally am not, and I don't think anybody is confident it's going to mean major changes, but I think it may mean two things. When Dodd-Frank was passed, over the last few years, it's like it was the Bible and nothing can be changed in it. I think hopefully we can start picking at the edges a little bit. And the other thing that gives me hope from the election is that maybe it just changes the environment or the thinking a little bit so regulations aren't advancing, whether it's on banking or anything else, quite as fast.
Okay, thanks. Dave, your thoughts?
Well, so there are some regulatory relief efforts, bills that, address some of the parts that Dodd-Frank that the industry would like to see changed. Dodd-Frank's not going to be repealed. It's not going away. And we can get those through the House. Don can speak pretty well on this topic, but we can get them through the House, but there was no go in the Senate. So maybe the Senate's changed a little bit, but I don't know that It's certainly changed where Republicans are in the majority, but you still have the president that can veto there. So I don't know as a practical matter, other than changing the environment a little bit, and the committee hearings and so forth might try to start to change the environment. We have one regulator, Consumer Protection Financial. How am I going to say it wrong? Financial Protection, anyway, CFPB. I'll just say CFPB, that's what we say. So it's a whole new regulator that's come out of Dodd-Frank. It basically has an unlimited budget, it has no oversight, and they're just getting started. So that's a major concern for the industry. Some of the things they do are good things that needed to be done, but there is a big agenda that they have that is just starting to roll out. As Don said, Dodd-Frank was passed 4 years ago. It's 55% actually enacted because there's a law, and then they have to put all the rules and regulations on top of it. They have to put the meat on the bones there, and they're just barely halfway done with that. So we just had new mortgage rules, basically, are new, in January, but there's still more to come on Dodd-Frank. So it's a gift that keeps on giving.
Just to give you a little feel for that, in the month of January, we had 6,000 pages of new mortgage rules go into effect. And there's hardly any way a bank of any size can deal with that. John Stumpf, the CEO of Wells, told me last fall that in the preceding 12 months, Wells had hired 500 lawyers, and they didn't deal with transactions at all. That was simply on the compliance side of the business. And then the support staff, they were about 1,000 people who simply were trying to keep the bank in compliance with all the new federal regulations. Well, there's no way smaller banks can deal with that. And that's one of the forces driving consolidation in the industry. They know that they can't be in compliance, and so they are seeking to get bigger. And often folks are just kind of worn out by the amount of regulation, so they want to exit the business. So they're glad to sell if they can get a decent price. But do one of you want to give them a glimpse of one that gives a flavor of the kind of fishing expeditions that are being launched these days? Talk about Operation Choke Point. Either of you?
So Operation Choke Point is effectively turning bankers into policemen. And there are certain industries that are not in favor. And frankly, there's some of them that are bad actors. But instead of going after the bad actors, and payday lending is one of those, I'm spacing out on the others.
Gambling.
Yeah, you can go down a long list of them, essentially legal enterprises. But what's occurred is that through safety and soundness, the regulators are coming back to the banks and saying, hey, this is a risk to your bank from a reputational risk. Because there's some bad actors in this group, you need to get rid of them, and we have to kick them out of the bank. And what's happening is whole industries are starting to really go through what the marijuana industry is going through here in Colorado. And it has nothing to do with what's legal, what's anything else. It is a bias or a legislature going through and changing the rules and saying, hey, what you're doing is not right, go to here. It's using banks to get that.
Yeah, in essence, you've got the Department of Justice at the federal level deciding that certain industries aren't good for the country, even though they are legal under state and federal laws, and basically using the banking system to just cut off financial services to them, which kills the businesses in the long run if that's successful. We've pushed back fairly hard, and so far I think we've stopped any further advance of that. But that's another little glimpse about one of the pressures that the banking industry's on now. Would one of you guys talk about how you see the size of the industry in 5 years from now here in Colorado? What consolidation will take place? What will it look like? We have 150 banks now. What's it going to look like in 5 years?
Will it be less? Koger talked about, there was, I forget the exact numbers, but there was a few years ago, there's 7,000 plus banks. Now there's 6,000 banks. If you talk to bankers in smaller banks, they used to say just within a couple of years ago, hey, you need to be at least 300 million in size to survive, to just kind of have some efficiency around the rules and regulations mainly. Then I heard the number go up to 500 million, and now I hear people saying $1 billion when you talk to them about the size they want to get to in order to survive. And Don described the number of banks. How many in Colorado? 150 total. Most of those are under any of those under 100 million. So you just have to look at the regulatory burden, that they see going forward. They don't all have great options. They need to consolidate. There aren't just buyers waiting in line these days too. So you have to have buyers to go with sellers. And there are some buyers, but there's some of those banks that people don't see a ton of value in. And so I think that makes it difficult as well. So I would say you would see continued consolidation. The bigger banks that are here mostly, will stay here. In addition to the big four, which were included in that, you still have other national, international players, Bank of the West, Compass Bank. You can go down the list. Those two banks are headquartered in Europe, actually. I mean, so we compete against the world here. The whole used to in banking, you could look on the other corner, and you say that's who we're competing with. Now you're competing against the whole world. And there's nothing wrong with that, but it's kind of changed the game where you do have to have a certain size, and you have to have a certain size to kind of from a technology standpoint as well.
I'm one that I don't believe this consolidation is good for us. And a little bit of background. I grew up on a ranch in northeast Colorado. We've been out there since 1876. In the 1980s, there was another tough time, and it was really tough for agriculture for a long time. And we were extremely fortunate that we had a really good banker in Sterling, Colorado, that had he not been a banker you could still look in the eye and say, I believe you, and our ranch wouldn't be around. We worked our way through it. But a lot of this consolidation is going to it'll hurt the worst or the most at-risk areas. So you're talking about rural areas that, large banks aren't going to want to go in there. Or when you make a decision, somebody in a faraway place makes a decision that we're going to lend at this level, or we're not going to do this sort of thing anymore. Or I don't care what the guy says. Look, we're going to do X with it. And that stuff is going to go away as these small banks go away. And that is a loss. That's a loss for our communities and our society.
Okay, why don't we wrap this up and give each of you a chance to raise other issues you think ought to be out on the table, or just summarize, make any final comments you want.
Yeah, I don't have much to add. I just think it's kind of an interesting time. The regulation is unprecedented, on our industry and on a lot of our borrowers as well. At the same time, the economy's doing pretty well. I would say the one thing that Koger mentioned before is true. Interest rates are at artificially almost low rates. At some point, that's going to change, and that's going to stress some borrowers, because I think a lot of projects that happen today, they're not stressed enough, and there will be more stressful times. When you look at a real estate deal, the rate's going to go up, the vacancies rate's going to go up, and the rents are going to go down, and then the cap rate's going to go up too. So it can change the values very, very quickly. And if you just look at that sort of debt load the country has, it's very cheap right now. They can borrow very cheaply, but that will change someday, and that's dollars that are going to come out of productive dollars that can be spent by the country as well. So I think that's out there a little bit, kind of that overhang, not even to get into the global situation. We don't have time for that.
Okay, Koger.
I'll pass.
Okay, Brian, I think we've wrapped up this part.
Absolutely. So before we open up to questions for the group, I'd like to ask each of you a question. And let's start with Dave. So every business owner here and every individual who has any loans out wants to know that one question: what's going to happen to interest rates over the next 12 to 24 months? What are your thoughts?
Well, like Koger said at the beginning, we're not economists, and not that they, know either. People have been predicting rates are going to start to creep up for a long time, and they really have not. Now the Fed is kind of backed out. Rates are still very, very low. The 10-year Treasury is kind of as low as it's been this month as it has been all year. The current predictions would say sort of second, third quarter next year, you would start to see rates rise, and what we would call the Fed funds rate or the borrowing rate, sort of the short-term rate, would start to go up. That doesn't mean long-term rates will go up in a like fashion, kind of the shape of the yield curve remains to be seen. But that would be the current prediction, is that the economy will be strong enough and that rates will start to go up, mid next year. But if you went back and looked at the last couple of years, you would see similar predictions, and they haven't come to fruition. So I don't know the answer, but that's just some commentary, I guess, on it.
Don, my next question is for you. So outside of working construction with my father on a rural community in the western slope of Colorado, and then bagging groceries at City Market, my first job was working at Olathe State Bank. And I was involved with Futures for Farmers of America, and we had a little project there. And Koger touched on this a little bit about rural communities and the impact. What are your thoughts? The Olathe State banks of the world, obviously they struggle with the services that the larger banks have. Do you believe that technology will help provide those services to the rural communities? Or do you think there's legislation or anything that needs to be put in place as it relates to serve them?
No, on the legislative front. We don't need
Had to
any
ask.
mandates. And I think technology will help, but it won't replace the branch that used to be a full freestanding bank in those communities. And I grew up in one a lot like Olathe, Saguache down in the San Luis Valley, probably much smaller than Olathe. Regretfully, in our little community, the bank failed when I was a senior in high school. The president spent some time in the pen over that. But at any rate, it failed, and that just crushed that little town. It just started dying, and I think that's what will still happen to an extent with all kinds of rural communities when the branch is closed in that community or in the next town. And there are ways that technology will help minimize that, but the impact is still going to be there, because you still, on the big banking transactions, have to sit across the desk from the banker and, explain all the information about how your business is going to make it. That's going to be much more difficult, and banks often do not like to lend outside of their market. They don't want to be one focused on Denver and then go into La Junta and make a loan. They don't know what's going on in La Junta, so they don't like that.
Interesting. So as a conversation starter after the event, you can go up to Don and try to spell Saguache. It's tricky, I'm not going to lie. Koger, there's a lot of concern about the level of the U.S. debt and what that means to us as a country in terms of things like freedom and opportunity for future generations. What are your thoughts with that?
I can't argue with that. And when you look at the actual debt of 17 trillion or whatever it is, but then the unfunded liabilities that are on top of that 4 or 5 times that, it is a very scary thing. And I think a lot of us have kids, and we look at what we're leaving for them, and it's clearly a significant issue. My personal view, it's got to be addressed. And I don't have great hope for that, because we tend to be where we address things by crisis. And by the time it gets to that point, I think it's very difficult. But clearly, it's a major issue.
With that, let's open it up to the group for questions. Yes?
Yeah, you made an interesting observation about the banks take the hit when you have cybersecurity breaches for retailers and things like that. I don't know, other industries, like hospital industries, the new HIPAA regulations, they now have clear downstream liability if they have breaches. But they also have this contractual power to be able to sort of dictate terms of what cybersecurity standards that their downstream people should be taking. Do you guys have anything like that in SOX? I mean, do you just have to take the hit, or do you have some way to be able to mitigate the risk of your clients that you end up paying for?
It varies a little by the payment system used, but in general, we don't have the safeguards in place that we need, and we're moving toward that, but that's going to take some time. And you've got a market where you have just millions of businesses accepting, let's say, Visa in this case. So all of that settlement is handled by the standard contract language that Visa uses when it signs up a merchant, Home Depot or whoever. And in that whole relationship, there is a process for reimbursement of the bank, but it's always kind of pennies on the dollar. And so we're trying to move in that direction contractually as well as legislatively, saying people are responsible for their own errors. And we are a long ways from that now, and that means that if a bank breaches or has a breach, that it ought to pay for that. There are a lot of consequences to this, but right now the consequences are pretty one-sided.
Someone else? Dave?
What is the expectation that you guys have for brick and mortar versus, the satellite operation in a grocery store versus digital activity, and where is it going for each of your companies?
Well, I'll pick off grocery stores first. Grocery stores are not a good place for banks going forward, and there's nothing wrong with that. Grocery stores don't want banks at the front best location in the store. They don't make as much money. Banks don't pull in as much traffic as they once, foot traffic as they once did. So I see that as very much a declining delivery channel for banks, and it makes sense for the grocery stores too. So I think that's a pretty easy one. I think we still need branches, but they don't need to be as close together because people don't need to go into them for service as much as they used to. So you don't need as many for service. You still need it for business customers quite a bit. And still, the main reason that you would open a new branch today is to acquire new business. It isn't so much for servicing existing customers. Even though some new business happens on the internet or mobile channel, the vast majority still happens in those branches. So I think it's still going to be a blend, but you'll have to prune your branch network over time, and you'll still open new ones, at the same time. But clearly, mobile is the growth channel. And that to me is an extension of internet, and that's not going away. You'll see more and more features, more and more investment. And if you're not pruning your expense as a bank in the branches, because that's how you get at your number of people, if you're not doing that, you're double paying, and you're not going to be successful in the long run financially.
Les, you had a question?
Yes, you had mentioned that we're in kind of a world economy right now with banking and finance, knowing you're not economists, but bankers. But it all comes down to the interface between the bankers and the personal and the commercial markets. We're in World War III, which is a financial market that's changing dramatically with challenges against the fiat currency in the US dollar. Currently, what's happening in a very near future is that there are a number of gold assets, gold-backed bonds from China, the Treasury Reserve note that was just signed off with Christine Lagarde and Obama this past Wednesday that was taken back to China, the TRN, and also the Iraqi currency, the dinar, that's about to come to the world marketplace. That's actively going on right now. There are many moving parts right now that affect and will probably eliminate eventually the fiat currency, the dollar, and maybe go to the US note, the United States note, Treasury note. So with all these changes happening in global finance, how do you see the US stacking up in the world markets when it comes to this huge change that's occurring with gold-backed currencies, the yuan, the renminbi, the Iraqi dinar, the Vietnam dong, and other currencies?
Koger just wrote a thesis on that, so he's going to answer that question for us. Go ahead, Koger.
I'm sorry, I have no ability to answer.
I'll just make one comment that we as a society resist a lot of change, but we also are very adaptable. We learn to roll with the punches, and there's a physical piece of evidence in downtown Denver of that. The old Colorado National Bank building that is now a hotel has 4 vaults in it. It has 3 very large vaults, and then a 4th one where the door is about this wide, and it's about this tall, and it's this high off the floor. It's where the door starts. Well, obviously, with a door up here about that size, and it's a big, heavy armored door, it can't be very deep because you'd have to crawl into it. It was a gold vault, I believe. We can't absolutely ascertain that, but that building was built when banks owned their own gold. They were required by the federal government to sell their gold. All non-jewelry gold was sold to the federal government. And I went back and looked at the stories that were written in that era about how the end of the world was coming because banks had to sell their gold. There was nothing there to back up the institution. We figured out how to work through that. I suspect we're going to figure out a way to deal with all sorts of changes that continue to come at us. I can't give you a specific answer. I'm sorry. I'm not that bright.
Get ready because it's coming and it's real. It's very real.
You bet. I was just meeting with one of the heads of GE Capital this week, and it's quite interesting. They were saying that all of the turmoil that's occurring overseas makes more and money come to America. And all these countries may have their different currencies and different opportunities coming to the world market, and I encourage that. I welcome that. At the same time, the safety net of the American society draws a lot of people here. But Nicole, you looks like you have a question back there.
Speaking of innovative technologies, and you were talking about how most bankers don't like change. I mean, they protect, they implement like Chuck operations, Chuck whatever that was, to guard yourself and whatnot. How often do you guys implement like meeting of the minds where you maybe grab a futuristic person, somebody who's just way outside the box, and sit with your bank on a regular basis just so that you can bounce ideas, so you see what's coming, and then you can, just meeting of the minds. Do you ever do anything like that, or do you just kind of keep the bankers with all the bankers and
Koger.
Come on, this one's gotta be yours.
You raise a really big issue for us, and that certainly is how do you deal with technology? We are in a risk-averse industry, and so our challenge, whether it's in credit, whether it's in technology, whether it's how we employ that or business plans, is how do we do it in a way that we're not on that cutting edge. And in Jim Collins' book, he talks about playing above the death line. And so as bankers, I mean, we hold deposits in trust. And so we are never going to be on that leading edge. And I can only speak as a community banker. What we have to do is we've got to weigh technology with our ability to have individual bankers craft individual solutions that the large banks simply can't do. And so our plan on technology is that we got to have somebody else prove it first, and then we'll go and implement it, because we simply do not have the resources to go out and develop technological solutions on our own. And we certainly can't risk our balance sheet on trying to be the one that says this is the idea.
I'd add to that too. Part of your question, I thought, was about gauging societal attitudes and where society is headed. We, as an association, stay out of that in terms of the individual banks and where the actual institutions are headed, but we do try to monitor attitudes about political shifts that are going on. And so we have an informal but effective way of doing daily monitoring of social media, as an example. I mean, the old style was you simply read the newspaper and you could pick up trends and all sorts of other informal ways. Well, now we do that through social media, and I'm just stunned at some of the things that we find that are really relevant to us, that will tell us what shift in politics is coming or what shift has already occurred that we just weren't aware of.
That's helpful. I want to make sure we get this side of the room. Chris, I listened to you last time. I want to make sure. We have Representative Swam here. You got a question?
Quick question. I've seen ads on TV, again, about no money down loans for houses. It reminds me of what was going on 408. What were all these big banking regulations that I thought were supposed to prevent that. Can you discuss that issue?
What I would say is that mortgages are made today. There's a couple of standards that have to be met. One is called QM, qualifying mortgages that are sold in the secondary market and securitized. And then there's another standard a little lower than that called ability to repay, which all mortgages have to meet, and we do a lot of those and keep on our own books, if you will. But what those standards don't address, they address basically that you have to have the debt coverage, the income, but they don't really address down payment, if you will. So that's one of the controversies in the industry. And so on the flip side, you can have someone that could put down 50% of a house purchase and they wouldn't qualify because let's say they just retired, they had the money to put down, but they don't have the demonstrated income, but you know that's a good loan, you know, because they have other liquid assets. So there's some things going on with that, you know, that are, you wouldn't think make a lot of common sense. So that's what needs to be sort of sorted out there. You just have now, there's not a lot of those no money down things. You just have Fannie Mae now saying, hey, we're going to look at 3% down loans versus 5%. So you do worry, I mean, a little bit of what are we going back to there, and will people have enough skin in the game, you know, and are we just setting ourselves up for another housing crisis or housing issues? And I'd suggest to you that over history, we know it will get loosened up over some period of time and will go too far again. It will just happen. It's happened so many times that it would be hard to say that'll never happen again. So
It's helpful. Let's take 2 more questions and then we'll wrap up here. Yes.
Brian, first of all, thank you. Good program. How do we stay educated on Main Street? And it seems like you folks are having a difficult time of just understanding the business yourselves. And point was made, you know, well, there are no more financial reporters, and even you're watching trends on social media. But I mean, I get the digital edition of Bloomberg. I usually have CNBC on TV during the day. But how do we stay informed? Other than coming to events like this, there's a million people in this town that aren't here tonight. What's a good source of information on a weekly or daily or monthly basis to understand what the hell's going on?
Well, I think you've identified key ones, you know, national financial media from Wall Street to Bloomberg, television or print is a good way to stay in touch with big national trends. But you're right, there is no local financial coverage to any great degree. Heather Draper at the Denver Business Journal is about as detailed as you get, and she does a good job, but she can't cover all the things that are relevant to consumers and small businesses in this sector and small businesses over in this sector. I would say that you ought to stay in close contact with the bank or banks that are relevant to you as a consumer or your business. You know, you will know the bank or banks that do the kind of lending that you're interested in. Stay in touch with them. Go into the branch. Find out what they're doing. Read their annual reports. Do a variety of things like that so you know what they are doing and what they're planning.
That's helpful. One last question. Yes.
Can you talk a little bit about Basel III and the current status of that and what impact it might have?
3A and 4 if you get a chance.
Oh, we'll stop with 3. You want to do it?
Well, I'll hit a couple things. So CBA here in Colorado and then the American bankers got really active, and some of the worst parts of that affected banks really got hit or went away. But I will tell you that they're, as it's coming up, it's going to have an impact. And I'll just give you a couple examples. There's a concept called high-value commercial real estate, and it's there's a number of pieces that fit in it. But effectively, we like to think of it as that there's a 26-year-old somewhere who never made a loan, decided what's high risk. But one of the impacts will be in that you have to put cash into it at a certain level. If you're developing a condominium project or things, and you have to leave it in there until the loan is completely repaid. So if you think about some high profile projects, kind of like one downtown Denver has a spire on it that goes through a long period. The way the tax laws are, you have to pay as you go along, and ultimately, so you sell, you pay taxes. We are not going to be able to release funds out of those for those things. That effectively puts bankers out of the business on that. There's a number of other things where they essentially are picking winners and losers, and I'll give you one other example. There's an expansion of capital that we have to hold for business lines, and those business lines, if they're undrawn, we effectively have to hold a certain amount of capital. That capital could be deployed somewhere else. So effectively, we lose money if we fund to a small business. Well, every small business or every big business needs sources of liquidity. That's going to make it harder for banks to do it. These are examples of things that are just sort of put on broad brushes that are going to have impacts on banks all the way across the board and have real impacts on everyday people trying to do everyday business.
Well, with that, I'd like to review a few golden nuggets. Each speaker that comes, I take some things away. And these gentlemen said some interesting things tonight. As a society, we address things by crisis. Just think for a moment if we would be more proactive versus reactive, and maybe what better decisions we might make as a society. When people are desperate, it can turn them into liars and cheats. Sadly, I think people in our federal government must be desperate, but we're not going to go there. But think about that for a second. Yeah, you have to be desperate to get there, and then once you're there. But just think about that for a moment. Was that what was meant in American society, to make our citizens desperate, to make them liars and cheats, when all they were trying to do was to pursue this great thing called opportunity? Dodd-Frank, pages that go past the ceiling. Think about that for a second. Having 500 attorneys trying to figure out how to interpret different documentation. Is that a good use of resources as a society? I like this one. We know it won't be good forever, and we do know that here, that's for sure. And then I like this one a lot. You have to prune your branch network to be efficient and to be viable. Think in your own life for a second what branches, metaphorical branches of course, need to be pruned in your personal life and in your business to make you more effective. As many of you may know, we take half the cost of your ticket, your $20 ticket, and pays for food and some drink. And the other half we donate to charitable organizations in and around Denver that are making a positive impact. In the month of December, we're going to take 100% of the proceeds and the cost of your ticket to donate to a few worthwhile charities. The first is Toys for Tots. If you're not familiar with it, Marines donate their time to go collect toys to give to kids who might not normally have a toy during the holiday season. At North Star Commercial Partners, my firm, we were recently honored to be able to donate 60,000 square feet to the Marines for the Toys for Tots program in one of our buildings. And we're going to place receptacles in every single one of our buildings all through the metro area that if you happen to go by, you'll be able to drop off a toy. When you come that evening, 100% of the proceeds are going to go to that organization and one other, and we encourage you to bring a toy as well to make a positive impact in a child's life. The other organization that we're going to support is the Battered Women's Shelter. These are women that are looking for safety and to think about how we can come alongside them and help them during the holiday season. So just think about that for your ticket cost, and also there'll be donation opportunities when you come. Jake Jabs will be joining us on Thursday, December 11th, which will be that event I just mentioned. For those that don't know Jake Jabs, he's the founder and CEO of American Furniture. And since 1975, I'm sure all of us have a piece of furniture from American Furniture in our house. I know I have several. But he's grown this organization into a $392 million a year operation that employs over 2,000 people. He's having a positive impact in this community, so we're excited to have him on Thursday, December 11th. And then on January 15th, we're honored to have Linda Childears, the president and CEO of the Daniels Foundation, and full disclaimer, Don's wife.
I didn't know that.
You didn't know that, did you? She just said yes to me the other day.
Okay.
So, if you don't know Linda, she had the opportunity to work with Bill Daniels. And Bill had a transformational impact in our state and continues to do so. She also was the president and CEO of Young Americans Bank, where we made a donation from the Opportunity Coalition. And under her leadership, they helped serve 500,000 kids in terms of growing their financial literacy. And now at Daniels, it's one of the best scholarships to have, and they're doing so many great things in our community, so we're honored to have that. So I want to thank all of you for coming here tonight. Please spread the word. Again, you can review each of these videos online, and you can also listen to the Opportunity Coalition podcast on iTunes or on our website. Thank you all for coming tonight. Appreciate it.
Brian, can I make one comment?
Yes.
I'm part of the Marine Corps Scholarship Foundation.
Uh-huh.
We donate scholarships to every Marine who ever served, every Navy corpsman who ever served, to their children. We put out $6.2 million of scholarships this year. They're usually on a basis of about $3,000. And we do golf tournaments in Colorado. We do a lot of things, so I want to get us engaged in that portion of what we do along with what you do.
Wonderful. Well, we'd love to learn more about it and come alongside. You know, we're big believers in giving back. There's a lot of great organizations out there. I once read just a few years ago, there's over 20,000 charities in Colorado alone. 20,000. Over 3/4 of them have budgets of under $20,000 a year. So don't ever forget that when you're writing a check for $5, $10, $100, or donating a toy, you're impacting somebody's life for the better, and so we want to encourage you to do that. Thank you all for coming tonight. Appreciate it.